Started. All right. So now we're live, and we give people a chance to kind of get settled here before we introduce our guest and get underway. Welcome to the weekly Camel Plan webinar, where we talk about ways to um, accumulate wealth and save on taxes. Again, we're going to give everybody a little bit of a minute to get settled, and then we'll get started here. Today, we're going to talk about turning underperforming real estate into reliable returns. And we've got an old friend with us that's joining us today, Bilal Fuquan. He has been around Camel Plan for a long, long time. We were trying to figure out what year, and we think it's about 2010.
Yeah,
So
yeah.
yeah, about 2010. So he's been with us a long time. And I got to meet him about 10 years ago, probably longer than that, 10 to 12 years ago, and became familiar with his work. And he's been an investor and fund manager for over 26 years. He's the founder and chief visionary officer of NNG Capital, and he's managing more than 60 million in private capital. And he deals with luxury ground up, value added multifamily repositioning, note investing. That's how I came to know him with the note investing. He's known for data driven decision making, hands on management, and a relentless focus on protecting investor capital while generating consistent cash flow. And I think he's wearing his cape to prove it. All right. So, all right. What I'm going to do is we've got a disclaimer. You know, the lawyers have to have their say. So, we're going to do that and we're going to get on to this. So it's really important. So, yeah, we are Camel Plan. We don't provide any investment advice or endorsements. We can't recommend or promote. Is for educational purposes only. We're not investment advisors, CPAs, realtors, attorneys. We didn't sleep at a Motel 6 or wherever. That makes us good for that. So if you need advice, and we always say this about every aspect of self-directed investing, consult your tax person, your CPA, your lawyer if necessary before you do anything. Self-direction means you are in control. So with that, I'm going to stop sharing. And Fuquan, I think you can go ahead and share the little green button
Okay,
in a tool tray there, puts you in
see it.
charge. Mm-hmm.
All right. Hopefully you can see my screen.
Started
Uh,
sharing. Yeah,
Hold on a second.
that's all right.
Over
This is
here.
pretty informal, so
Yep.
take your time getting. I
There we
can
go. There
see.
we go.
There we go.
All right. Awesome.
Oh, what a nice looking building.
Yeah. So today we're going to talk about transforming underutilized real estate assets into high performing assets. So, yeah, it's been a 26-year journey for me. And I was at a real estate conference a few months ago, and people actually stood up and start clapping. I guess they've been doing real estate for like 10 years, and I was like 26 years. I felt like a dinosaur. It's like,
Ah,
but it's been an interesting journey. Going through the global financial crisis and then the last COVID thing and everything else, it kind of helps you um, grow up, right?
mm,
And so anyway, we're gonna talk about a few things here. There may be some of you who are not investing in alternative assets. Some people may still be in traditional assets, so I'll cover a little bit about that as well. Um, but yeah, this is my disclaimer also. This is informational for informational purposes. We encourage you to do your own research, consult with trusted advisors before making any decisions, and we're happy to answer any questions. Definitely appreciate your time and consideration for taking the time to watch this presentation now, or if you're watching it later on. So as I mentioned earlier, it's been a 26-year journey for me. Started off in residential. I kind of cut my teeth and, as they say, jumped out the window and grew wings falling down. Back in 99, just really focusing on fix and flips. And I didn't have any rentals, didn't know anything about cash flow. I just knew that those big chunks of cash was really sexy. Buying a property, fixing it, selling it. And when the market crashed, I learned very quickly that cash flow is king. Those small $300, $200 a month payments make a difference. I was much younger back then, and it was, do I want to get a rental and make $200, $300 a month, or do I want to flip this property and make 25, 30,000? So of course it was the latter. So chasing, that, and the mindset was a slave of money and not a master of money, right? Just was very transactional. And when the market crashed, I learned a lot. And that's actually when I discovered the note business. And somewhere around 2009, 2010, I started to get educated in the note business, started to make my own investments when, I picked my face up off the ground after the market crash, late 2010. About 2012, I was investing my own capital. 2013, after I had a few case studies using my own capital, going over the hill and getting the arrow in my back, so to speak, I launched NNG Capital, which was the first fund that we actually raised. We launched to raise capital to buy notes. And since then we transitioned to a more diversified model. So throughout my career, I successfully raised and managed over $60 million, and basically it's really being able to have scalability, the capital, and also the assets to be successful. So, what you'll learn is four keys. I mean, four key roles for a strong investment portfolio. Why alternative assets deserve a spot in your portfolio? What makes alternative assets so powerful? And our approach to maximizing value while managing risk. So, as I mentioned, we was established. The fund was established for a bridge and a gap between institutional grade investments and uh, investment opportunities for individual investors. So I like to say that we're a small boutique firm. We try to laser focus on two things. Right now we're focused on luxury spec homes in northern New Jersey, 30, 40 minutes the most away from the city, and also multifamily properties in central Georgia. So that's kind of what we focus on. We don't really do too much in the note space as of now, especially after COVID. We kind of made a pivot from that. It's a lot going on. And pretty much what I learned in the note business is that the attorneys make all the money. So, but the real estate, hard assets, for the most part, you can control, once you get permitted to do the job, the timeline, the processes to get things done efficiently. And for the multifamily, we self-manage. That's something I had to learn over the years also. Instead of giving that responsibility to a property manager, it's really hard to find somebody who, have your best interests and, monitoring the bottom line. So, those are the two verticals that we currently laser focus on: are luxury spec homes in Northern Jersey and multifamily properties in Central Georgia. So our strategy is rooted in selective acquisitions. We hands-on, like I said, we do asset management, and this helps us to drive consistent risk-adjusted returns for our investors. So this is just a timeline that I just mentioned. Got started in '99, and basically, all the way up to 2022, we finally hit the 50 million target raise. And so I have another slide later that kind of shows what happens after that, but this is four jobs of your investment portfolio, right? You need a diversity, generate consistent income, stable investment asset, and capital growth through appreciation. And that can be with, multifamily investments or holding rentals for long term. So why alternative investments is a higher returns and value creation, market-driven upside. There's some tax advantages, which I'm pretty sure the listeners are aware of or currently already doing. Stable cash flow and passive income, and diversification and risk management. So, this lowers overall portfolio risk, reduces exposure to volatility, and it spreads investments across assets. So these are different types of alternatives, which I'm pretty sure the audience is familiar with, whether it's crypto, collectible intangibles, commodities, hedge funds, infrastructures, private debt, private equities, and real estate. Is there anything here you can't invest with the IRA?
Crypto is a little bit different. You can invest in LLCs that buy, sell, and trade crypto. You could set up a checkbook LLC to do it, and then repatriate your profits back into your IRA. Everything else we see. Oh, the collectibles and tangibles. There's some limits there. You can't put fine art or Persian rugs or you know antiques in there, that sort of thing. So there are some limitations, but everything else, commodity, hedge fund stuff, infrastructure, private debt, it's all wide open.
Awesome. But we see most investments are in private equity, debt funds, and real estate. That's kind of where
Mm-hmm.
we see most of our investors that invest from their IRA. But this is how they line up against each other. You can see, hands down, real estate is the main one, right? So income, long-term growth, purchasing power protection, tax benefits, and low to no correlation, right? So you're not going to have an announcement made and then shares go down, or announcement made and shares go up. Um, it's hard, right? Because my youngest son, he's into crypto heavy, and I don't invest in it because I'm a real estate guy. But
Mm-hmm.
he's dabbling in it, and I like it because he's building an investment mindset. And he loves it. I mean, he was just sharing with me, from the announcement that was made last week. He was like, "Oh man, we could have made X return, or you could have did this, you could have did that, you could have went further because you have more money than me." So he's playing around with like $10,000, and he's seeing his money grow, going down, grow, but just building that investor mindset. I love it. But these are some alts that you should look into if you don't currently have any in your portfolio. Definitely helps create that diversity. And this is four reasons to invest in alternatives: it's to achieve a greater flexibility in retirement, boost your financial freedom, definitely helps you create multiple streams of income, and protect your future self and generation. So higher returns, faster goals help you turbocharge your IRA. If you're doing like growth deals, you have to be careful for UBIT though. Pretty sure, if you're in deals where you're in for a short term and you gain a lot of profits, but just having that lifestyle, and that's kind of how I like to look at my investments, is something that's going to help me protect my future self and generation, and it's a lifestyle business. So I just want to give a quick example. I don't know if have you ever heard of the group Tiger 21?
I have not. Tell us
Mm.
about it.
Mm. So this is a group. You have to have $30 million in liquidity to be a part of this group, but I was able to connect with them, find more information because I go to conferences where there's high net worth individuals, and then they tell me the different associations and the masterminds and things that they are part of. And they mentioned this to me, so I quickly went and did some research, reached out to them, asked some questions, registered, and they sent me how they invest. Right, so I'm on their mailing list, and they go, "Hey, here's how the ultra wealthy invest. We don't just go all traditional. We have a split with our portfolio." And what was interesting to me is majority of it was alternatives. It was actually shocking. I was like, "Wow," because you would think people are just traditional bond and
Mm-hmm.
those other strategies besides alts. And it seems like the market is shifting now, and people, especially the bigger hedge funds, are going after real estate and doing more alternative investments. But it was pretty interesting. This portfolio here reflects a 23-9-68 split between stock, bonds, and alternatives, divergent from the traditional 60-40 model, which you'll see, right? This means higher focus on illiquid, high growth assets and lower emphasis on liquidity and income stability, designed for long-term capital appreciation. So what you'll see is, the allocation, this gives like a 20-year play, right?
Mm.
So already, if you look at if you look at the bottom, you'll see somewhere around even a year three, you see 40,000 to 134,000. And if you go over 20 years, it's $4 million difference, 11.4 to 7.3. So this pretty much shows, over 20 years, alternative portfolio strategy outperforms the traditional 60-40, because it's a $4.1 million net worth difference. So definitely, if you're not like doing more with alts, I definitely would say invest into alternative. That's just a $3 million portfolio, what that looks like, right? Over 20 years. So here's some of the alternatives that we invest in. I'm pretty sure you guys are familiar with multifamily. Our approach is a little different. We kind of do affordable homes. I come from low income. I grew up in North New Jersey, pretty rough area, Section 8, single parent household. So what gave me my feeling of importance when I got involved in real estate was going back to these communities and adding value, whether it was, doing better than the slumlords, better quality renovations, putting the properties back on a tax roll, cleaning the community up of dilapidated property. So that was a really good feeling for me, and I got really good at it. And then really after COVID, what we decided to do is because New Jersey is a blue state, so it's more tenant friendly, and we had a lot of challenges with basically people who said, "I got COVID, I can't pay rent." So we decided to, divest that portfolio. We had a lot of New Yorkers coming in and paying 30% over list. And I was like, I haven't seen a market like this since 2006, 2007. It was like a dead cat bounced.
Hmm.
The market came back and it was a mass exodus from the city. And people were moving in areas where I wouldn't believe. You had a lot of people from Brooklyn, Manhattan, moving over to like Irvington, Northeast Orange, where these are really low income areas. And we saw a lot of people that were moving from New York over into New Jersey, buying two or three of these properties and moving their family over. And that kind of increased market 30% of a list. So we divested the portfolio, took the war chest, and started to build a portfolio in the Southeast. And we are able now to do our impact project on a larger scale. And that's taking uh, complex to community, right? So going into providing affordable housing for low income families, battered women and children, seniors who can't afford a rent bump, giving them quality affordable housing. There's some tax credits that you get benefits from there. And you get stable income from having a percentage of those government assistant units. So it's a diversified tenant base, cost efficiency and property operations, and there's a strong demand due to economic development initiatives. So it's a housing shortage, as you guys know. It's a nationwide lack of affordability. So this drives a persistent demand for multifamily solutions. So, it's shelters a necessity, and affordability challenges pretty much amplify the multifamily resident relevance. So our advantage here is, buying properties that are underperforming, whether it's through management, whether it's through low rents. Most of the properties we target are below 20% we can increase rents 20% more. The landlords probably had deferred maintenance, they didn't increase them. So, we don't do like any syndications or anything. We buy this in our fund. So if we're doing ground up projects or we're doing multifamily, it's all in the same vehicle. It's not a separate syndication. So most of these are structured where, investor will get a pref plus, an equity upside. And what I've seen on most of the investments that I've been in, been promised, hey, you're going to make 18% or 22% or 2x. Usually it ends up somewhere between 10 and 12 for the ones I've been, which is still good for me, right? So 8% is good for me. As long as I'm not losing principal, especially in this market, is good for me. But we decided to go this route because it creates diversity within our model, and investors really can benefit by investing in that model versus a syndication. So lower risk, spread across all the tenants. And the way we structure is multiple sources of income because it's income from the ground up construction projects that we do, the luxury homes, and also from the multifamily. So it gives reliable cash flow, and this model is less reliant on smaller rental properties. So our strategy is basically acquiring or just mentioning underperforming assets, right? We self-manage, so we run daily operations, CapEx, property management is on our payroll. The employees there belong to us, so we have a little bit more control versus abdicating the responsibility to a property manager. So basically, it's a better financial solution for us. Quality housing is, like I said, one of the things that we focused on in these distressed communities, and it becomes a win-win situation when we have that mindset of complex to community. So you have all different types of investors. Some investors are drunk off yield and they want to go off the highest return. Some investors want to make an impact with their dollars. So, pretty much that's kind of where we are. So our deal criteria is C plus to B minus properties that could be from anywhere from a 1978 property to 1990 or 2000s property. We kind of target anywhere from 40 units to 100 units. that's not in competition with the other guys. So we find a lot of opportunities from brokers, and also property managers. So we require our tenants to qualify to make at least three times the rent. And population growth, we want to see also vacancy, not greater than 7%, less than 7%, and it needs to have at least 88 to 95% occupancy so we can get permanent financing. That's another thing that we see, which led to where the multifamily space is now. And there's a lot of challenges because of properties that were purchased with the anticipation of refinancing later. And then 2022, when the 10-year shift in Q4, the rates doubled. So a lot of operators got in trouble. So now we target units that are almost 90% occupied or more, so we get permanent financing. So this is kind of where we are in Middle Georgia with the multifamily. We like that area because it's like 40 minutes away from Atlanta. And a typical deal scenario, it will be a mismanaged property, is over leverage or owner uncertainty, or a person is older and they're trying to exit, which gives us the opportunity to bring my note business skills in and have the owner create a note, right? So that'd be a situation if it's not 80% occupied and we can get permanent financing, then we'll do the strategy of telling the owner, hey, if you sell this, you're going to have a big tax event. Maybe you could become the bank and partner in a deal until we stabilize it 3 years later. Maybe you give us like a 6%. We'll give you some money at closing. And then once we stabilize, we'll refinance out, whether it's HUD or, through Fannie Freddie, and basically the loan will get paid off, which is a different tax situation for you. So, we find the deals, we underwrite them, we do due diligence, we execute it, and then there's really the most important part that I've learned over the years about multifamily is asset management. People get excited, they're high-fiving when they close a deal, they raise the capital, and the real performance is in asset management. We generate leads from direct to owners, local real estate brokers, property managers. And then, this is pretty much the process that we go through to kind of screen a deal, stress test it, due diligence. And it's a bunch of things that we kind of go through in underwriting. Operational efficiency is something that we're always focusing on, whether we are implementing RUBS, which is a ratio utility billing system for a common area, to actually try to increase the bottom line by cutting those expenses. Doing upgrades, we look at how much we're going to spend in each unit. Like, we're not going to go and over improve a unit. So when we're going to buy it, we'll go, hey, we can turn these units for less than 5,000 a unit, and that would be LTV flooring, vanity, small stuff that we'll do just to like take care of whatever deferred maintenance or whatever the previous owners didn't do. So I like the space because, again, it helps us create our impact project, and investors have a great opportunity to have more diversity on that. So the luxury spec homes, basically, we transition again after COVID. We made two moves. One was divesting the New Jersey rental portfolio we had and doing that on a larger scale in the Southeast, and then also became very competitive to buy hoods in buy homes in the low income areas, and it was less profitable. So we kind of transitioned to luxury spec homes. And what we found here is that these are very profitable. I mean, I have some case studies that I'm gonna show, but it's a lot of different things that I like about it. One is we don't have to worry about materials being stolen, the house being broken into after you renovate it, and people stealing it. And it's just a good feeling to create a product still under our mantra, quality housing, right? So in the Southeast is quality affordable housing. Here in the Northeast is quality housing, which is the luxury spec homes. Building ground up, right? Or doing an addition to an existing house, tearing it down to the foundation. It just provides a better quality product. And you'll see, especially when you build ground up in New Jersey, you have to do a 10-year warranty. So if you're going to buy a property and you're looking at two different properties, are you going to look at something that was just like, gutted and rehab or fix and flip, or something that's new construction, especially if you're spending $1 million, $1.5 million, right? You want to get the best bang for your buck, so to speak. So we like that because it sets us apart from our competition. There's a strong demand from high net worth buyers. Still a lot of New Yorkers who probably have a two-bedroom apartment for $1.5 million. They now can move to New Jersey, catch a train to the city, have a backyard for their kids, and just have more entertaining space and everything. So profit margins are higher there as well. Remember, these are in our fund, these two different verticals. So it's not the traditional way you'll see real estate where someone would attach a note to a property and they'll make a monthly payment. Like a lot of you guys probably are lenders on deals where you get like a first or second mortgage, you get those monthly payments. And so this is a one of the verticals in our fund. So we kind of target and focus on high net worth individuals, whether it is professionals, attorneys, doctors. This is who we make this product for. We sell houses anywhere from $1.5 million to $2.5 million. And there's a local economist that I follow here and subscribe to his website, and I get the reports and everything. It actually showed in Q2 that houses over $2 million transacted and sold more than houses 400,000 or less. This is for New Jersey. It was actually I think it was 20 or 20 something percent more of the houses 2 million above sold. But it was just a law that was passed, which is easier for me to fix on my end. But the mansion tax has been passed to the seller now. It used to be the buyer.
Hmm.
You pay 1% of the purchase
Wow.
price, and they just passed that to the seller. It's 1% for a million, 2% for 2 million, 3% for 3 million. So now we just have to build that into the cost. I mean, that's basically what it is, right? So, but yeah, it's we develop exit strategies for a fast turnaround time. We may look at a property where we don't have to tear it down completely. We could just add an addition, and make improvements that way and turn it around faster. So we're typically, if it's a 4,000 square foot or 4,500 square foot home, it would take us anywhere between 12 and 18 months, just depending on the town. But if it's really just an addition, we could be in and out in less than a year. The architecture drawings and permits, that takes about 90 days. And, build time is about 6 months. So these are pretty much for affluent buyers. And there's limited like new construction, right? So rising land development costs slowed down luxury builds, and it's a increasing demand for renovated high-end homes also. So these are the counties that we're in: Morris County, Bergen County. Strong school systems, wealthy zip codes. Houses selling between 1.2 million to 3.5 million. So we like to play it in this space. Union County is another one. Essex County. You have Livingston, Short Hills, Chatham. These are really towns. So there's houses in Alpine, New Jersey for like $30 million. I'm like, it's gonna buy a $30 million house. It's like, but it's amazing, right? When I started researching in the luxury market, because it was a mindset shift for me, right? Because before that, before COVID, the most I probably sold a house for was maybe 350. That was the safe space, right? Affordable housing, FHA, somebody can get a loan. That's the bread and butter, fast transactions. After COVID, pricing increased, and now it's forget about it, right? Which you would buy for $1 million a day, 20 years ago, you can get acres for $1 million. So just a different space. But those are the counties that we're in. We source deals from brokers, basically direct to seller, public tax records, probate, and people get rid of this stuff for life events, unwanted properties. There's tax liens, inherited properties, and we kind of go through a whole process. I'm not going to go through all of this because it's pretty lengthy, but I we have like a really good process that we go through, and if it could be from construction, analyzing a deal, everything, and it's just to make sure that that product at the end is quality. And we mitigate risk by really going through these so we a price per square foot is what we kind of built with our contractors, so we know if we're going to do new construction versus rebuild, what the price per square foot is going to be. And having people know if you're doing any construction or flips or whatever, it's really the timeline of getting the construction done and the cost that hurts you. So if you can manage that process and have a standard operating procedure in place, that will really help you, then you can execute better. And also creating a material procurement plan. So we actually take the whole process to a PowerPoint presentation, create scopes of works, and make it more efficient. We have like QR codes on the house, so it's really driven that way where it's systematic, right? That's the scalability part I was saying in the beginning, is the capital to buy the assets being available, and being able to scale the business by having these processes in place. That was something I had to learn over the years, right? So people, strategy, execution, and cash, right? The four parts of the business. You really have to try to be successful in all of that in order to run a good business. So, but yeah, these are, affluent homes, affluent families, status seekers, buyers upgrading. These are the type of people that are purchasing these properties. So, this is my leadership team that, helps me do a lot of stuff. And then basically, this was the slide that I got to earlier where I was talking about the journey, from 2013 to now. So, it's been exciting. It's been a long journey. Still learning. That's one thing I like about real estate, is that you're always learning. There's so many different facets. There's so many different things, and we just love it. So I'll just go through a few quick case studies, and then I'll open it up for some questions. So this is a 64 unit in Alabama that was 58% occupied, and it was mismanaged, and we were able to buy this and turn it around. So we transitioned this to self-management, and we purchased this property. We own this property for 3 years now, and we were able to increase the NOI and increase the value of the property. So that's essentially what happened. You'll buy an underperforming property, you'll make improvements, whether there's management change, whether there's curb appeal, or most of the value comes in rent growth. So once you are able to increase rents, and what I liked about this is the occupancy was so low, we had a lot of vacancies. So we had the opportunity to turn those units and bring in rents higher. And then the rest of the residents, as they leases ended, we were able to start, increasing those rents to drive the value of the property. We were able to implement RUBS, which is the common area utilities, water and electrical, so we can, cut those expenses also. So these are the type of repairs that we do in these type of units. Vinyl flooring, this simple stuff, simple, clean, easy, repaving the driveway, just go in and make it look really nice. So this is another one. Actually, we just purchased this one last year in May. This is 142 units. This was a unicorn deal, I call, because we were able to assume the mortgage. It was 98% occupied, I believe. We got it for somewhere $9.5 million, and we were able to increase occupancy, raise rents, and basically, increase value. So that's really the goal. These are long-term plays also. These are 5 to 7 year plays. And this is the type of renovations that we do. Same thing, vinyl flooring, just nice, clean appliances, pave the driveway, go in and do that. So this is one we passed on. This was the 83 unit. This was actually right across the street from the 142 unit. And we kind of passed on this one. Basically, it was only a 5% upside for rents, and it was below our 15 to 20% target. As I mentioned earlier, we like to buy deals where rents are 20% below market at least, right? So, this was only 5% below market, and there was a lot of capital expenditures that needed to be done. So, we stuck to our criteria, ensuring the returns that we need. And if anybody wants to see this deal, you can scan a QR code and you'll see this is the one we passed on. This is right across the street from where we are, so you can get a look at what that looks like. Here's some New Jersey stuff here. So this is, track record of some stuff we've done over the years. But I wanted to show you this real quick. The luxury spec home. So this is a deal we actually just closed last year. I think it was June last year we closed it. So all-in cost is 1,250,000. Fair market value was 1,800,000. We sold it for 1,860,000. And this house, you can scan a QR code also with your cell phone, and you can see the build from the foundation all the way up. There's a little short video. If you scan a QR code, that will show you that. This is what the inside finishes look like. So these are the high-end finishes that we do. The goal is for when they have the open house, the husband and wife comes in, the husband will not be able to sleep at night. That's the goal that we aim
I
for.
love it.
So we kind of, build them as if we were going to live there, right? So these are the finishes that we do. These are not cheap Home Depot finishes. I mean, there's nothing wrong with that, right?
Gorgeous.
But we finish them so they just got to move their furniture in, and that's it. Here's another one, is a little bit more modern. You can scan a QR code on this as well. This is another ground up project. To the left is what it looked like, and to the right is the finish. This one we actually took a haircut. This sold December of last year. Timing of the market was kind of slow. We wanted to get out of the deal. We still did okay, but we could have got more. But profit is profit, right? This is what the inside of that one looks like, similar to the other one. A few different things we did: flooring, vanities. But it's like a cookie cutter model. So here's another one in Union County, Berkeley Heights. This one we took down to the existing foundation, no addition, just built it high. As you can see, the house was like one story. We built another story. And the house was, this was also sold in December. So we did okay on this one, not as good as the others, but this is typically, what it looks like. Similar finishes here. This is kind of what we do with all our properties. So, you know, we have access to multiple markets, whether it's in the Southeast or here in New Jersey. Having those two verticals in the fund helps reduce risk. And basically, expert management, things run smoother. And I think, well, I know self-managing our multifamilies is easier for us because we're direct to the employees there. We can give direction, we can shift, where we go. So basically, what we offer our capital partners is, quarterly updates, financials, reports, online access to a portal. We kind of walk them through some of the due diligence as we have our quarterly updates or whatever, and pretty much go from there. And you can scan this as well. These are just some testimonials for some of our investors. So the reasons people invest with us, again, because of the deep local market expertise, multiple exit strategies. Again, these are two verticals that we have in one vehicle. Um, and this is pretty much, what we offer to our investors. And this is a mezz fund. So this is a lending fund where, for example, we have in our flagship fund some multifamily properties we purchased, like a 40 unit that's under construction. We have some another property in Columbus, Georgia that's under construction. So instead of going out into a mezz lender and pay 17%, we just created a vehicle where our capital partners can get, monthly payments. It's a deferred interest program that we have set up. So if you're interested in that, you can reach out and we can discuss that and figure out what your investing journey is and what your goals are. But most this is a mezz debt fund, so basically you're behind senior, and we'll use that capital again to help stabilize those assets, and then we'll refinance and kind of pay off that mezz debt. So if you're interested, you can schedule a call, review the PPM, and basically go from there. So I'll open it up for questions if anybody have any questions now. I think my
Sure, just
battery died
just
on
a
my
few.
phone.
I mean, the 3-year term, does that apply to all levels?
Yeah, so it's a 3-year term. I'll go back to the slide. It just depends on, how much capital that they invest.
Okay.
Your phone dies these days and you think it's the end of the world. I'm like, I'm
Yeah.
disconnected.
That's pretty much
Um,
true.
yeah, so the way we set this up is a pref and it's deferred interest. Again, when you go to get mezz debt, usually the mezz lenders, it's really short term. It's maybe 18 months or 2 years, and then the fund will charge like 17% and maybe pay their investors 10 or 11%. They have an arbitrage. That's what we've seen. And it's really tough to pay 17%. So the way we structured ours, whichever class they're in, is a six pref and the rest is deferred.
Mm.
And they get paid at the exit. So that gives us the ability to raise capital at 6% essentially to be able to stabilize our investments and have low cost of capital. And then the investor gets rewarded at the end on the exit. And I believe that's the smartest way to do it versus paying someone, 17, 16%. You have like the chokehold on you to kind of meet that interest. So that's kind of where we are. And there's an option to compound on it.
Nice.
So, that's pretty much, how that works.
You may have answered this question with the case studies, but one question was you select, and the Southeast is hot for a lot of reasons, but you selected properties approximately 45 minutes away from Atlanta. And the two cases that you presented that were in that had employers, one was Amazon and the other one was near a military facility. So I'm assuming in answer to this question that whenever you select properties, you're looking at, this is a workforce housing play, this is affordable housing play. I'm sure these folks are not all commuting to Atlanta. There are local employers, and there's
For sure.
yeah.
Yeah, I mean, the point is for me, right? Atlanta is a hot market, but it's so expensive. It's like 130, 120 a door
Mm-hmm.
versus, in Macon, I can get it for 75 a door, 83 a door. And there's just so much room for growth, right? And the model is affordability. My son actually went to school as soon as he graduated from high school. He went to school down south, and most of my family is in Atlanta. And he rented him and my nephew a two-bedroom apartment. It was like 1,800 bucks, plus rubs and park and everything. It was like almost 2,200 bucks when it was all said and done.
Wow.
And it wasn't um, like a top line apartment. It was like basic, and the community was like it was okay. Versus Macon, that same two-bedroom is 850, right? And
Wow.
it's 45 minutes away from Atlanta. So you do have some people more people are migrating like further south for, the cost of living, and they still work in Atlanta. They still commute to Atlanta. And if you're in the South, if anyone has any family, an hour drive is normal. Like
It
40-minute
it
drive
is.
is
It is.
normal, right?
Yeah. I spent
That's why I
20 years in
refuse to move
Houston.
there.
Same thing.
It's
Yeah.
like most of my family migrated there. I'm still here in the North. It's like, who wants to drive 40 minutes to go to the grocery? I don't know.
It's yeah, commutes are yeah, long commutes are typical in cities that were built around the car. I spent 20 years in Houston, another few in Dallas. I've had family in Los Angeles and temporarily in the Atlanta area, and that's just normal.
Hmm.
And the infrastructure is built, so commuting that distance, 45 minutes an hour a day, is not that big a deal. Um,
Yeah, if you scan the QR code here for Invest Clearly, also you can see some of the projects that we've done. We're set up on that site, and we've loaded a lot of the videos of the before and after, and some of the stuff that we've done there. And if you get a chance, you can go there and check us out also.
mhm. You had an interesting pivot when COVID hit, and you played off the demand for properties within the metro area, but outside of New York City, and you sold those properties at a premium. So you were taking advantage of what was going on, the market dynamics at the time. And you seem to be doing the same thing in the luxury market, which is that's a fascinating glimpse into that because um, we have a lot of operators that are taking advantage of different verticals in and around the New York metropolitan area um, because there's always going to be demand for property in and around those areas. So what happens in the city sometimes is properties will go down a little bit, but the major cities of the world, London, Paris, New York, they kind of don't react to the typical economic cycles in the way that, say, cities in Florida or perhaps Texas do. So it really interesting glimpse um, into that market.
Yeah, I mean, for me, it was a mindset shift really to go from 350, $400,000 ARV houses to 1.5 million to 2.5 million, because you always think that, sometimes those houses are still on the market for 6 months before they sell, but the profits are bigger,
Mm,
right? So, now, even now, we're kind of changing a bit that strategy, still doing ground up luxury spec homes, but doing just adding more quicker turns in here. So there are properties in these areas, right, where you don't have to tear down, right? They may just have outdated kitchens and bathrooms, and you can go in and do your thing and still have that luxury finish. Um, you know, some of them may have already HVAC units already in there. Some of them don't. So you have to go in and be able to make those upgrades in a timely manner to be in and out to to speed up your cash conversion cycle. That's the only thing about the luxury spec homes is the cash conversion cycle is kind of slow because it's 12 to 18 months.
Mm.
But that's why we have the cash flowing assets and those in the same vehicle, in our flagship fund.
Yeah,
So
there's a balance there.
yeah,
Yeah, the rental properties provide some ballast, and the spec properties provide some juice to the returns.
yeah,
And then, about how many properties are you turning on the luxury side each year?
yeah. We have 12 projects, 10 to 12 projects a year that we typically focus on. And the average spread, as you can see, is 250 to 350, somewhere around there, closer to like the 300, 350 range.
Okay.
There's one deal we're doing now. It's supposed to close next week. We've been into it for about a year. It's in Berkeley Heights. It's a 5,500 square foot house. Well, it's 5,500 square feet above ground, and there's another 2,500-foot
Wow.
basement, walkout basement. So it's a huge house on an acre. Winning a contract for 2.2 million. We're all in for like 1.4 million. So that's a really big hit. That's a really big hit. So
Wow.
we're going to be excited when we close that one. So looking forward to that. But those deals, they're out there. And you have most builders, they'll do one or two deals like that a year, and they're good. What I'm competing against is builders who's using their own cash.
Mm.
So their cost of capital is cheaper than what we have. So, um, again, the structure of the Mez Fund is to help us raise the capital, do the construction, do the things that we need. So when we do have a big exit, we can, take care of our investors.
Yeah, it's high altitude, but that's an area of the market that's not as affected from employment standpoint, from income standpoint. Um, generally they're you know the, the prospective buyers are well capitalized themselves. So, but an interesting glimpse into a great sliver. I know you've got a hard finish at 55. So, um, one more question: how many that someone had? How many doors do you have in the fund, the rental properties?
Yeah, it's close to 1,000 doors. Our BHAG, our Big Hairy Audacious goal is provide quality affordable housing for 5,000 families.
Okay.
So it's a journey. Multifamily is a slow, I was gonna say grind, because that's the first thing that came to my mind, to be honest. It's a slow grind. And what I've seen, like I said, is I'm a part of a few syndications, three syndications that I'm a part of. One is actually about to exit, and we're not going to get the returns that were marketed to us. But they still look decent. They still double digit. I think it was somewhere like 11 and some change, but that's what I've been seeing in between 10 and 12. So when I decided to, dive into the multifamily space, I looked at the syndication model. Then I said, you know what, I'm going to do something different. Because back then it was all growth model, like investors were looking for growth. And I had a debt fund, and it was like debt versus equity. Everybody, it just depends on where you are in your investment journey, right? So some people are younger and they're looking for growth. Some people are older, they're just looking for cash flow, so they invest more into debt. Um, but when I looked at that, I was like, I actually would rather have it in one vehicle. So um, if I have cash flow from the multifamily, then I have the ground up construction property selling. All that cash is going into one vehicle.
Mm.
Right. So if the performance on an asset, because it will happen, it just depends on where you are. Insurance increased 70% on one of our assets in multifamily, which was insane. But what are you going to do, right? It's systemic in the market. And you have all these different things that happen that you have to continuously monitor that's increasing your expenses. So if you're in a syndication, that drops down the profitability. So, I'm glad that I went the route that I went because, I can have an exit on a single family that bring in a big profit to kind of cover up some of the challenges that you have, in the multifamily space. So, that's kind of what I like about it. But it's no easy way. You kind of learn as you go and grow from there. So
Interesting approach. Really appreciate you coming in and sharing it with us. Do you want to put up your contact information one more time
Yeah,
if
for sure, for
anybody's
sure.
interested
So
and
I'll do that here.
get you to get
If
in
you guys
touch?
are interested, I'll love to set up, a discovery call, learn more about your investment journey, and see if there's anything that we can do to help you along, or share some of my experiences with you guys, and pretty much go from there.
And thank you to our audience members who took time out of their day to visit with us, and also those who are watching it on the replay. Fuquan, take care of yourself, my friend. I'm sure I'll see you at events and rattling around this business sometime soon in the
Absolutely.
future. Okay.
Absolutely. Thanks a lot.
All right, my friend. Take care now.
All right.
Bye bye.